Over the past few years, I've delivered a workshop sponsored by Export Development Canada and attended by hundreds of owners, managers, and others in small to mid-sized businesses across the country. What I've talked about on behalf of VDC is managing risk and cash flow in a global supply chain. Recently, we asked ourselves, how should we continue to deliver our message to Canadian businesses? What's the best way to reach the widest possible audience? Well, the answer, of course, was to find a rooftop and to speak a little louder than usual. International trade can open a world of opportunity for your business, leading to new customers in new markets to make your business more sustainable and drive revenue growth beyond what is possible from domestic sales alone. However, all the potential benefits of going global with your business come with greater financial and operational risks. There's increased counterparty risks. Will your customers pay you on time, in the way you expected, and as much as you planned on? What about your suppliers, who might be further away and harder to manage? Will they deliver what you need when you need it? Suddenly, no matter which way you look, the stakes are different. You depend on other parties in ways that might be unfamiliar to you. Everything takes longer, and everything is more complex. Think about negotiating and executing contracts with buyers and suppliers who may be overseas and follow different business practices. That might also have different legal systems. You might be dealing with multiple currencies, buying in US dollars and Japanese yen, paying employees and operating expenses in Canadian funds, and selling in euros. Production and delivery times are often extended. There's clearly a need to manage cash flow and risk more vigilantly as your supply chain gets longer and more complex. If you don't, you won't succeed in the long term, period. So what can you do to manage the risks associated with international trade? How do you set the right conditions for success in the pre-contract, production, credit, and warranty periods that occur in just about every single global transaction? Let's imagine a typical mid-sized Canadian company that's asking the same questions. It has customers in Europe. Meanwhile, it's building a supply chain into the Far East to reduce costs. It takes months to produce custom-built goods, and then they have to be shipped to their buyers. The company has to provide performance and warranty bonds to assure its buyers that it will deliver as promised. There's an ongoing requirement for regulatory and trade compliance in Canada and overseas in the countries that the goods are coming from and going to. How much working capital will such a not-so-fictitious company need, taking into account that it might also have to deal with advance payments to suppliers and accept longer payment terms from customers? How will it manage foreign exchange risks and the risks of non-payment by clients? For every step along the way, there is a challenge, but there's also a solution. Going global requires that you expand your ability to visualize the art of the possible. Just as important is having the right people with the right knowledge, the right partnerships with the right organizations, and deploying everything you've got effectively at the right time to mitigate the risks and to drive cash flow. We'll explore all that and more in the following episodes. We've all heard it, cash is king. For the next few minutes, I want to talk about cash and how and when it comes and goes and why that's important. I also want to talk about liquidity and how you can create it. So first of all, what is cash flow? Very simply, it's the movement of cash in and out of a business. But there's a catch. It's got to be measured over a finite period of time. That's the critical factor. Cash will almost always flow, but will it flow fast enough and in sufficient quantity to cover your obligations? That's what you have to ask yourself. Companies can be profitable, but if they have poor cash flow, they can go bankrupt. I know, I've seen it. So how do you manage cash flow effectively? One of the most important steps is to look at your cash to cash or cash conversion cycle. That's the elapsed time, measured in days, between when you pay a supplier for its goods and services and when your customer pays you for the goods and services that you have sold to it. Do you have enough capital to carry you through that period? And if you don't, where do you get it? Here are three concepts you need to understand. First and foremost, there's days sales outstanding, or DSO. That's how long you have to wait to get paid by your customer. Days inventory outstanding, or DIO, measures how much inventory you have to carry on your balance sheet to satisfy orders. And finally, there's days payable outstanding, or DPO, which is all about how much credit your suppliers give to you. If you add the first two, DSO and DIO, and subtract DPO, You'll know how many days of capital you require to fund ongoing operations. But here's what happens when you get into international trade. DSO climbs as customers take longer to pay you. Meanwhile, your supply chains are more complex and more inventory is required to ensure that you mitigate the risk of disruptions in the delivery of goods and satisfy the needs of your customers. That means DIO actually goes up. And if you have a lot of foreign suppliers, you could actually get less supplier credit compared with what you would get in North America. To put that into perspective, consider the fictional Canadian company we introduced earlier. Domestically, it's got a 54-day cash conversion cycle, comprising 57 days of DSO, 47 days of DIO, and 50 days of DPO. Which means, for its size of about $8.1 million in revenue and a cost of sales of about 70% of revenue, that company needs about $1.2 million on hand to fund its operations. When the company goes global, its DSO can easily jump to 90 days or more. By simply being unable to collect as quickly, due perhaps to standard practices in foreign countries, the cash conversion period can easily almost double. In this case, it goes to 87 days. That same company now needs $1.9 million. That's significant. So where are the levers in all of this, and how can they be used to your advantage? You've got to start by asking some important and fundamental questions. First, how do you structure payment terms so that you get paid sooner? What instruments can you use to collect more efficiently? How do you work with your customers and your suppliers to optimize the levels of inventory across your entire supply chain? How do you work with suppliers to negotiate terms that favor your business and contribute to a shorter cash conversion cycle? And finally, what financial and other intermediaries do you need to engage to help you achieve your objectives? It's all about making sure your cash stays king. To do that, you need to plan carefully, which is what I'll talk more about next. Here's something that seems so obvious, and yet sadly is often forgotten or overlooked in the excitement to close a deal. Success in business is often achieved before the contract is ever signed. By that, I mean it's really during the pre-contract period that you have the opportunity to anticipate all of the possible challenges ahead and set the conditions for a successful transaction. There's so much you can and should do to de-risk a transaction in your business and to enhance cash flow just by spending a little bit more time planning an order before you actually take one. Think ahead. What can you do to protect your margins? How can you control costs as much as possible before signing a deal? How can you protect the cash that will be coming and going if you're dealing in multiple currencies and with foreign buyers and foreign suppliers? And what about all the other tedious details, such as actually reading a contract in its entirety and perhaps managing forecasts and scenarios for cash flow? What should you do during the pre-contract period so that you're bidding for success? To start with, you have to realize that you're making a proposal at a particular price based on costs that aren't predictable. Those costs may change before an order is received or even in the middle of filling the order. They may move up or down. If you're selling in a foreign currency or sourcing in a foreign currency, those currencies can move adversely against you. So one thing you can do, as much as possible, is to try to match your input currencies to your output currencies to minimize potential cost increases. You can also look at strategies to buy inventory at a fixed price or negotiate favorable supply agreements that provide some cost stability. That's how you start to protect yourself on the cost side of the ledger. On the foreign exchange side, you should be thinking about a hedging strategy. Hedging is a means, using financial instruments, to fix the exchange rate between two currencies so that future changes in exchange rate do not adversely affect a company. Creating a strategy involves answering, how much do you need to hedge, and which instruments? Whether it's a forward contract, an option, or maybe a futures contract, is the most effective way to ensure that the cash that will be coming in and going out is what you expect in Canadian dollars. You should also be looking really carefully at your customers and suppliers, whether they're blue chip or mom and pop small businesses, to ensure their creditworthiness and solvency. And finally, you have to read the contract. And I mean really read it, no matter how excited you are about the sale. That's the only way to know for sure if it contains any of what I call landmine clauses that can absolutely jeopardize the future of your business. There may be indemnity clauses that can bankrupt you if things go wrong. Who owns the intellectual property involved in the transaction? What insurance coverage is required? What kinds of performance guarantees are you committing to? What happens if you're late delivering? Are there penalties? And if there are, how will they affect your bottom line? What are the terms of delivery? How much cash will be tied up during the production or even the warranty periods? And what are the implications to you if your client cancels their order partway through production? All of those things need to be considered. Even better, they should be modeled in a forecast that shows what your business's cash flow will look like over the course of an order and what the impact will be on your company if anything slides off the rails. You need to anticipate as much as possible and plan for it to make sure that you have the capital and contingencies in place to address any issues that could arise and to minimize the impact on your company's cash flow. Supply chains are the lifeblood of any global business. Yet over the years, I've observed that many buyers and sellers are often working at cross purposes rather than as partners. I'm a firm believer that companies that build strong, resilient, and agile supply chains are also building competitive advantage. So how do you do that, especially when the demands of your customers and your suppliers are often seemingly at odds with each other and your needs as an organization? You have to focus on a variety of things. First, there's the importance of managing working capital and maintaining cash flow. Then it's about building strong supplier and customer relationships. Finally, it's about effectively managing all of the regulatory and compliance issues that go with moving goods from suppliers through to your customers. Let's take our fictional company, for example. It gets an unusually large order from a European organization. Let's say the deal's worth 2 million euros, and the payment terms are unfavorable. The company's only getting 10% up front and the rest 60 days after delivery. Before even starting work and receiving the 10% advance payment, it also has to provide a performance bond to ensure to the buyer that it will perform under the terms of the contract. Meanwhile, the company needs key components from a foreign supplier, let's say some Japanese robotics, which means it must spend cash up front in order to place this order. Right away, there's a huge impact on the company's capital, stressing its ability to fund the project costs. It will almost certainly have to work with its financial institution to secure the additional funds it needs to fulfill the contract and address the fund cash flow requirements. The company also has to work closely with and keep an eye on its suppliers. The three greatest risks in any supply chain are quality, delivery, and solvency. How do you make sure a supplier delivers what you need when you need it, and that the supplier will be around to support you through an entire order and the warranty period? I can tell you, it's no fun having to fix someone else's mistakes and quality deficiencies. Finally, there's the matter of trade compliance. The process of ensuring that international business transactions observe all applicable laws and regulations, from getting permits to dealing with tariffs, duties, and taxes, and ensuring that documentation and reporting rules are followed. Compliance can be a giant black hole that can really hurt small and mid-sized businesses if they fail to pay attention to it. Yet, it's often critical to getting goods into and out of countries efficiently. If it's not done absolutely correctly, it can add costs and create risk in the form of delays, fines, and other penalties. So what do? First, you need to find the right processes that enable you to collaborate and communicate effectively and efficiently with both customers and suppliers. It's about using information technologies to make that happen quickly and reliably, and about putting lean processes in place to minimize the amount of white space created by non-value-added activities. So if you look at our fictional company, for example, it can execute on big orders by having the right suppliers delivering the right goods at the right time, by having the right relationships with the right financial institutions, freight forwarders, and customs brokers, by building the right communications and collaborations processes with its customers and suppliers, and by bringing the right risk management and financing solutions into place, whether that's insurance against suppliers who fail to perform, support for additional capital and bonding that's required to complete an order, or credit insurance against the risk of non-payment by a customer. Putting all of that into place and making it visible and transparent is what allows companies to compete and succeed globally. In my experience, a lot of companies focus mainly on getting the goods out the door. There's almost a collective sigh of relief the moment the truck pulls away from the loading dock. And yet, everything can still fall apart. Your goods actually have to get to your customer, and they have to perform as the client expects. You also need to get paid. In the pre-contract phase, you've set the conditions for success by negotiating a contract that protects your margins and cash flow. But perhaps you didn't. The good news is that you can frequently address those issues after a contract starts. Perhaps not as advantageously, but you can still take some of the necessary steps to protect yourself against many risks. You've also built a really strong supply chain, and based on it, you've built quality products that deliver to your customer. Now that those products are shipped, what could possibly go wrong? A lot, actually, if you don't have the right processes and practice in place to effectively manage the logistics and financing activities that occur during this next critical phase. So, what are some of the things you need to consider? With regard to logistics, you should be thinking about the terms and conditions of shipment. And for payment, you should be asking, what's my collection risk? What's my currency risk? Have I protected myself against either or both? There's also that period of time between when you ship and when you finally get paid, the credit period. How can you monetize the buyer's obligation to you during that period? What can you do? Regarding shipment, you need someone with expertise in global logistics and who understands Incoterms, either within your company or as a partner who knows your business and can help you identify what's best for you. With the right knowledge, you can negotiate favorable terms and conditions for your company and properly address the issues of who carries which risks and absorbs which costs and who has the responsibility for the movement of your goods. If you don't negotiate those terms properly, it could end up costing you significant sums that you didn't anticipate during the pre-contract period. On the collection side, if you've granted your customer open account terms, have you set the conditions to ensure that you get paid? And if you're not sure about payment, have you covered the risk with credit insurance? Have you addressed the foreign exchange risk? What if you signed that deal for 2 million euros when they were worth $1.55 Canadian and now they're trading at $1.40? Have you put the right forward contracts in place to protect your cash receipts? Finally, in the whole period during which you're granting credit to your customers, what can you do to create additional cash flow or capital for your business, either by selling the receivables or by borrowing against the value of them as collateral? Those are just a few of the things that companies should be thinking about during the collection and post-shipment phase with a single purpose, to ensure that they get exactly what they planned for all along. A lot of people might think that when you get paid, it's over. But is it? International trade isn't all about risk. It's about opportunity. And the even better news? There are tools and solutions available at each step of the way to help you protect yourself against the many challenges that come with expanding your business into the global marketplace. That extends even beyond the delivery and installation period of a sale, when you might be obliged to provide a warranty. That's a financial liability to you, and there could also be cash tied up as collateral for a warranty bond that can extend over multiple years. So you need to ensure that you have the processes in place to manage your reverse logistics and warranty supply chains. Even when you've actually delivered the goods, the potential impact on your company's cash flow doesn't end. But as I said at the outset, it doesn't matter whether you're in the pre-contract phase, the production period, the collection period, or the warranty period. There's always something you can do, a process that you can implement, or a third-party solution that you can acquire, whether it's an insurance solution, financing, or a guarantee, to effectively mitigate the risks and allow your business to focus on the opportunities ahead. Doing business internationally isn't so different from doing business at home. It's a bit more complex, but you can manage that complexity with careful planning, strong business processes, the right people with the right knowledge, the right partnerships, and above all, a determination to make international trade truly the art of the possible.